Options trading may seem complicated at first, but the basic idea is actually simple. An option is a contract that gives someone the right to buy or sell a stock at a specific price before a certain date. There are two types of options, call options and put options. A call option gives you the right to buy a stock at a fixed price, called the strike price. A put option gives you the right to sell a stock at a fixed price. Every option also has an expiration date, which is the final day the contract is valid. Here's a simple example. Imagine a stock is trading at $120 per share. You believe the stock will go up, so instead of buying the stock directly, you buy a call option with a strike price of $120. If the stock later rises to $135, your option becomes valuable because you still have the right to buy the stock at $120, even though the market price is much higher. Put options work the opposite way. Suppose you own shares of a company and you are worried the stock price might fall. You could buy a put option with a strike price of $120. If the stock drops to $100, your put option still allows you to sell at $120, helping protect you from losses. The easiest way to understand options is to think of them like insurance. Imagine you buy a brand new Ferrari. You would probably buy insurance to protect yourself financially in case something bad happens. Options work very similarly for investors. Let's say you buy 100 shares of a stock at $125 per share. Your total investment is $12,500. But stock prices can move down unexpectedly, exposing you to risk. To protect yourself, you could buy a put option. Think of it as insurance for your investment. Suppose this protection costs $500 and lasts for 30 days. Now let's look at two outcomes. In the first scenario, the stock rises from $125 to $132 per share. Since you own 100 shares, you make $700. But because you paid $500 for the option, your final profit is only $200. Now imagine the opposite scenario. Instead of rising, the stock falls to $113 per share. Without protection, you would lose $1,200. But because you purchased the put option, you still have the right to sell your shares at $125. This protects your investment from the major drop. In this case, your only real loss is the $500 you spent on the option. This is one reason investors use options, risk management. But options can also be used for leverage. For example, maybe you believe a stock will rise, but buying 100 shares is too expensive. Instead of spending $12,500 up front, you could buy a call option for only a few $100s. If the stock moves higher, the value of your option increases, allowing you to profit with much less capital. And if the trade goes against you, your maximum loss is limited to the amount you paid for the option. In simple terms, buying a call option means you expect the stock to rise. Buying a put option means you expect the stock to fall. Options provide flexibility, protection, and the ability to trade with less money, but they also involve risk. That's why understanding the basics is essential before trading them.